right, good morning. Today is 2/22/2023, and I am back with another edition of the Wednesday live show. And let's see what's going on today. The Fed minutes. Fed minutes are going to be released at 2 o'clock, and that's probably the major action of the day. And the market's kind of dull this morning, but yesterday, interestingly enough, we finally got a breakout of this recent range here, right? Now I got a bunch of lines on the chart, but let's see if I can get my little drawing tool up. As you recall, last week we were looking at this sort of range right here, and interestingly enough, most participants, it seems like, expected that range to break to the upside, right? I mean, it just seemed like it, right? We've had this sort of big beginning of the year rally here into February, and then of course, this was a nice little sort of bull flag right here, and it really seemed like the market was kind of, acting well, and there was a lot of buyers, and it just seemed like, obviously there was a few dips there, and it seemed like they were getting bought, but it just seemed like, especially coming off of this rally, sort of felt like that range was going to break to the upside. Interestingly enough, I also compared it to this range, and the funny thing is that I went back earlier in the week. So this is a weird week. We had President's Day on Monday, but I went back earlier in the week and I read some of the news headlines, like right around here, about why the market like dropped, right? You remember at the time we looked at that, and that was one of the more significant sort of breakaway runs to the downside that we've seen in a long time. Um, I mean, typically, the market will, have the ups and downs and that type of thing, but this sort of two breakaway gaps to the downside was pretty incredible. And so, anyway, back to what I was saying originally is I went back and looked at the news, and the news was, like right around here, was basically that the market was worried about inflation, rising interest rates, and a slowing economy, right? Like the three sort of things that the market worries about, right? Inflation obviously is an ongoing problem, and the second part of that is rising interest rates because the Fed is hell bent on quashing inflation by raising rates. And remember last year we had a couple of big rallies, especially this one here, July and August, based on the idea that the Fed was going to pivot, right? I mean, I can't tell you how many times I heard people discuss about the Fed pivoting, and of course we talked about that back then. But anyway, long story short, the same three reasons that the market, fell out of this range to the downside here are the exact same it's the same narrative as what we're facing right now. You know, inflation, rising interest rates, and a slowing economy. And so it's kind of interesting. Um, the funny thing is, obviously, that the market here, and let me zoom out a little bit on this chart here. I got the big downward sloping trend line, which obviously got broken to the upside. So, I mean, that's kind of a positive sign. Then we have a golden cross right here. The blue line is the 200-day moving average. This orange line is the 50-day moving average. And then we got this big round number of 4,000 here, which the market's trying to find some support on. And of course, we have the rising trend line. And, of course, same thing we looked at last week. Rising trend line, downward sloping trend line, the consolidation area. So basically, yesterday was, I believe they said, was the worst day, coming off the worst day since of the whole year, right? and since December. So yeah, yesterday was the biggest down day of the year. It doesn't look like a whole lot on the chart, quite honestly. It's interesting to see today, and if I zoom in on this a little bit, it's interesting to see how 4,000 is such an important sort of level, which I guess makes sense. Big round number, that type of thing. So anyway, this is where we are. You can't really see. Let me move my chart up here. Let me move this up a little bit so you can see. I usually keep the indicator panel hidden on the bottom here, but you can see the RSI. The RSI actually kind of got overbought back here when we hit this this recent high here, close to 4,200. RSI was just right at about 70 then, got a little overbought, and so as the market's kind of just drifted sideways, you can see that the RSI's come down and is below 50, right? So relative strength is deteriorating. It seems like the problems that I discussed a minute ago, as far as rising interest rates, inflation, slowing economy, are still present. And interestingly enough, let me zoom back out one more time. The same problems are present at the exact same level, basically. I mean, for all intents and purposes, it was the same level. The difference is, obviously, back over here, it was below the 50-day. It was well below the 200-day. That trend line had basically been established at that point. So, but it's just interesting to note how the market consolidated like at the same level there. So that's kind of interesting. Zooming in here, what I see is tons of support just below the current price, right? So, a lot of times something like the Fed minutes coming out today. It's interesting. I was thinking about this morning, that I do these shows on Wednesdays, and Wednesdays a lot of times Wednesdays are always Fed announcement days, right? And then I guess I don't really know for sure, but Fed minutes come out, so it seems like there's a lot of times that I'm doing the show on a Wednesday that there's some kind of pending news that has the potential of driving the market. The funny thing about the Fed minutes is that it's obviously it's obviously hindsight, right? And so everyone's going to try and interpret whether the Fed minutes were dovish or hawkish or whatever. And the crazy thing about where we are with the market is, and I saw somebody post this yesterday, that nothing matters except what the Fed does, because I wish I had saved this chart, but S&P earnings are down considerably, right? Which leads me to mention that we're right sort of in the thick of earnings season here, right? There's I think this week are tons and tons and tons of earnings. It seems like all the major companies, like 65 or 70% of the S&P is already reported, but there's thousands of companies out there, and a lot of the smaller ones are reporting this week, and so we're kind of right in the thick of earnings season. But when all's said and done, I think when about 65% of S&P companies had reported, I saw a chart that showed that they were down significantly. I mean, the earnings had been up, and then they've kind of rolled over, last couple quarters, and as of right now, they're down significantly. So, you remember before earnings season, everyone's saying, well, whatever the market does is going to be based on earnings and that, and so there's obviously a lot of moving pieces, and then the last Fed announcement, which was just a couple of weeks back, I think it was 2 weeks, I don't know, maybe 3, but anyway, the last Fed announcement, the market, the market seemed to think that the Fed was almost done, and then basically what we've heard since then, right? They've passed their blackout period, and so like it seems like I just saw Billard a minute ago on CNBC. I think he talked this morning. It must have been a replay, but anyway, the Fed is insistent that, for one thing, they're going to hold interest rates at elevated levels for the remainder of this year. They keep saying that over and over and over, and it's like the market doesn't believe what they say, right? Or at least it's the market so far has kind of like pretended it doesn't believe that, that they're going to be as aggressive as they say they will, and they just keep reiterating over and over. And so just recently, since the last Fed announcement, um, inflation, I think it was like PPI or something like that, came in a little hotter than expected, and I think they're very concerned about reemergence of inflation, right? And I mean, they're a long way from their 2% target. And so, all of a sudden the market is looking at, you know, a couple of more rate hikes. And now they're talking about 50 basis points at the next one or whatever. And so, they're nowhere near a pivot. And it's just going to be interesting to see how it all plays out. So when these minutes come out today, I guess what we're going to find out is, how hawkish they really are. The crazy thing about the last Fed announcement a couple of weeks ago was it's like the market wasn't hearing what Powell was saying, as I recall, because in the past, last year or whatever, the market would attempt to rally on, hopes for a pivot or a slowdown or, or the terminal rate being at a certain point. But anyway, it sounded to me like, what I just said, that Powell was relatively hawkish, and that, they're going to keep their pedal to the metal, so to speak, as we go forward, and they have absolutely no plans at all for lowering interest rates. And quite frankly, they would rather see, asset prices deflate orderly, because that's basically, how you put a stop to inflation. And so, an inflation rate of 6% is terrible. So, and the crazy thing is, obviously we've talked about this. The inflation rate peaked, back last summer and has been coming down. But, every time I go to the store, man, the price of everything's gone up again. And so, and like I always say, once inflation, say the inflation rate comes back down to 2%, well, that doesn't mean prices are coming down, right? That just means that the prices are probably not going to go up as fast as they did before. And so, the fact that they let the inflation genie out of the bottle to begin with is, and so the main thing here is that they cannot let inflation, they can't let it like start to accelerate again. And one of the things that everybody's real cognizant of is the price of oil. So, and I've always said for years, for as long as I can remember, whenever I talk about inflation, I always thought that, I always believed, and I still do, that oil is like one of the major contributing factors. So, on the outside chance that the price of oil starts going up, then they have a problem. So, well, they have a problem anyway. I mean, the Fed has a big problem. They basically caused the inflation, and so now they're trying to quash the rate of inflation from going up, but general price levels have risen, and it's created a big problem. So the other thing that I talked about last week, which is kind of humorous right now, because all of a sudden this week, like after the 3-day President's Day weekend, I'm starting to hear a lot more discussion on what I talked about last week, which is the fact that, 2-year notes at about, almost 5% risk-free yield are starting to become more attractive than equities, because, and especially for, large sums of money because we went for years and years and years with interest rates, at practically nothing. And so I mean, if you had $1 million and you were looking to and you were looking to deploy it at 1%, the interest rates, I mean, you were looking at 10 grand a year, which wasn't enough to do anything with or to live off of. And so the Fed basically forced everyone into risk assets over the years with, zero, and so nowadays, though, now that interest rates have risen substantially, it's a whole different ballgame. As a matter of fact, the rate of interest rate increases, going from going from practically 0 to almost 5% on the short end, is like the fastest interest rate rise in 40 years or something like that. And so there will be repercussions. Obviously, everybody talks about how there's a 6-month lag with everything, and so same with like what I was talking about before, oil prices. Like if oil prices, were to start rising substantially, say, there's a lag between that and how long it takes before it starts to create a general price increase in the overall economy. And so, but anyway, back to the interest rate. So now with the risk-free rate of about 5%, the people that were chased into risk assets because they couldn't earn a risk-free return on their money that was worth anything, all of a sudden now if you got that $1 million that you need to deploy, you can just put it in 2-year notes or whatever. I mean, you can, basically you can get almost 5%. So now, little old lady that's retired is thinking, well, why would I risk my money in stocks when I can get almost 5%, say 5%, that's 50 grand a year. And so now they can basically, an average retired person can live off of the income without touching the principal from their nest egg by being in bonds instead of stocks. And so, I mean, that's the whole, I mean, if everybody learned all that back in basic economics class, it's kind of like, I talk about interest rates and home prices, sort of being like one of those old-fashioned scales with two sides on it, and there's sort of an equilibrium. So anyway, the Fed's number one job, or well, one of their two mandates is stable prices, which is kind of funny because every single person, if they think about it, knows that knows that the prices of everything has been rising their whole life. And it's just funny. It's about, so then it becomes about, how fast does the general price level of everything rise. But yeah, I mean, right now I go to the grocery store and I get sticker shock. Right, I get sticker shock. I mean, you don't really bat an eye when something was like $2 and something, now it's $3 and something, or something was 3 something, now it's 4 something. But even it's interesting because people that follow economics and follow the markets and are in all this stuff, they pay a lot of attention to this. But I was talking to my mom the other day, and she was talking about how the coffee creamer that she used to buy for like 3 something was like over $7 now. And so she's like, everything at the store's gotten so expensive. And so yeah, I mean, obviously it's no mystery to anyone that goes grocery shopping or pays property taxes or property insurance, car insurance, I mean, everything just about. There's, obviously there's certain things that technology type stuff tends to get cheaper, which is the saving grace. I like to joke that, economists recommend buying a new TV every year to offset rising prices in other places, right? Because, over the years, the prices of electronic devices and certain things like that have come down a lot. And, there's stuff, lots of cheap stuff from China. But the things like health insurance and property insurance and health, anything having to do with healthcare has risen dramatically. And so, um, like I say, prices have been rising my whole life, and the Fed cannot let what I think they're most afraid of, and this happened back in the 70s. As a matter of fact, I wasn't, back in the 70s, I didn't care about inflation or anything having to do with that. I mean, but apparently back then there was like what they call waves of inflation, and so, you know, they would have like a bout of inflation, and then it would calm down and come down for a few quarters, and they would think that, that they won the battle, and then inflation would surge again and resurge. And so I think Powell mentioned something about Volcker or whatever, and I don't know much about the inflation of the 70s, but I've heard a few, interesting stories and read a few things about it. But anyway, so at this point in time, the Fed is, I think, most concerned that because the economy, according to them, appears to still be relatively robust, right? And they look at the jobs and all that, and yeah, it's an interesting. There's a lot of pieces to the puzzle, like I always say, and we're kind of in an interesting spot because I know, around here, geez, there's lots of places hiring, and they're paying, what used to be big money for menial type of jobs. But so the Fed looks at that and says, and of course people are still spending money on vacations and going out and doing stuff and that. And so the economy, and the other funny thing is, like, the Atlanta GDP forecast, and I'm not sure when GDP comes out. It's coming up here. Um, and so, like, they have their forecast. I've looked at the chart last week. It ranges from like 2% growth to minus 2%. And so they have no, they honestly, we have no idea whether the economy is actually growing or if it's below the zero line. So it's going to be really interesting to see what happens when GDP comes out. But the Fed's in a pickle because they need to bring the inflation rate down. If the economy is still robust, my guess is, and I think, part of the market was kind of acting a little bit delusional here, because everything that I just said kind of lends itself to, more of a down market than an up market, right? So, interestingly enough, when the Fed minutes come out today, we're gonna see how the market interprets them. So we're in a spot right now where, whoops, I didn't mean to draw that. We're in a spot right now where, you know, the actual the actual market itself, the chart, I should say, the chart itself is looking like the market wants to pull back, but there's so much support here that it's almost going to take some sort of a shock to break through this support. I would expect, and we're kind of oversold here a little bit, so I kind of expect some maybe consolidation. Maybe maybe we do a little bit of work down here, sort of at the lower end of the range. The bullish the bullish narrative holds basically as long as this particular trend line holds. Right? I mean, we're still in an uptrend, so quite frankly, you could let's see, where did my drawing tools go? Here we go, trend line. Yeah, these. Okay, there you go. So we got sort of a channel working too, right? You can draw kind of a channel. If I actually make those two lines perpendicular, basically it looks like we're just kind of trading down towards the bottom of this bigger channel. So it's all about this rising trend line. You can see, markets like sitting right on the 50-day here. I look over at my screen and see that all of a sudden we're getting a big bounce, you know. Um, so we went from, well, the S&P's is poking below 4,000 here, but the futures just went from below 4,000 to back above 4,000. So today's honestly the morning session today is just probably not going to be much going on until the market decides, what it wants to do when the Fed minutes come out, which of course I expect to be, the exact same thing that we've been hearing all this time and the same thing Powell said. But it's just interesting that it was kind of interpreted as being dovish when in fact it didn't sound like that to me. But tons of support here. So you can't get overly pessimistic at this point. The market's kind of in its own world. Personally, just based on the macro picture, and that's always a mistake, is to base anything on the macro picture because the market's in its own world, right? They always say the market's not the economy and this and that, but just based on like what we know and everything I just discussed, the market should probably be a little bit lower than it is now. So they managed to, and there's a lot of reasons where the market likes to, rally at the beginning of a new year. There's probably a lot of money getting deployed, but the main thing to watch out for, the main thing to keep considering is that, the major trends kind of evolve over a longer period of time. And so the funny thing is, yesterday morning, yesterday was the worst trade day of the year. Barely a blip on the chart, but worst day of the year so far. And I get up in the morning and see futures down significantly, and they're like, oh, well, Walmart, the CEO of Walmart said that, the economy, the consumer's not as strong as everybody thinks or whatever. And that was the reason given. But the real talk yesterday was about rising interest rates, and then everybody started talking about, what I mentioned last week and what I just mentioned, the fact that, all of a sudden the risk-free return in, T-bills is pretty darn attractive, and the stock market's extremely volatile. So that's sort of the main theme going forward. Interest rates are probably going to remain elevated. The Fed is, barring some sort of epic crisis, which, is always a possibility, the Fed has no plans whatsoever to, to pivot and lower rates. And if anything, we're looking at a couple of more rate increases in the old, what they call the terminal rate. That's where the Fed, finally pauses and says, okay, we're done hiking rates. Terminal rate has crept up too, and so everything's going to be about, whether people want to continue to put money in equities or, maybe new money gets put to work in T-bills and bonds for that risk-free rate. So anyway, that's about it. Looking through a bunch of charts, we have a little bit of activity going on as far as swing trades go, but now that I think going into next week, the majority of earnings will be behind us, and we'll have a little bit clearer picture. Don't lose sight of the fact that now that we've broken out of this little box here to the downside, it's probably not a good idea at all to just be like crazy aggressive here, expecting that, okay, the market's just going to turn around and rally back up and break out the top of this. So maybe if it does some work at the lower end of the range, sort of holds this trend line, does something like this, consolidates here, and then starts back up. But the over and under is 4,000 now. You remember for the longest time, I would draw a horizontal line at 3,900, and that was a huge level. And so, it still may come into play. These trend line crosses are just a shade over 3,900, so that seems like, and there's the 200-day moving average. So the market's got tons of support below, but it's also, the near term trend is down. And of course we're kind of oversold here, right? I mean, we're working on the fourth down day here in a row. And so it wouldn't surprise me to see a little bounce, but now there's a bunch of overhead resistance. So we're kind of in no man's land. Right? Now that we've broken down out of this consolidation, up here, to 4,100 now is going to be sort of a resistance level. So market's in no man's land. We're waiting on the Fed minutes to likely give us the direction. Never rule out the possibility that we could be down at this trend line, relatively quickly. So be interesting to see. Anyways, that's all I got for today. So thanks for tuning in. I will see you here same time next week.